Good morning, good afternoon, good evening, wherever you are, and welcome to the E-Institute's webinar series. This is a free monthly series that discusses cutting-edge issues and developments. Experts from the World Bank Group and our partners will share the latest approaches on topics such as jobs, social entrepreneurship, green growth, and so on through online presentations. The goal of this webinar series is to educate and foster discussion around frontier topics in development. While the series is targeted largely towards development practitioners and policymakers, really everyone is welcome to attend. Today we have a very interesting agenda planned. We have here Asli Demirel-Kunt, who is the director in the research group of the World Bank and also the chief economist of the private sector development network of the bank. And Asli today will discuss really the global financial crisis and has changed and challenged the conventional thinking on financial sector policies. It has reopened a fundamental question: what should be the role of state as owner, regulator, overseer, or promoter in the financial development? So the World Bank's first ever Global Financial Development Report addresses these questions, building on new data sets, surveys, research, and country experiences. And Asli will share with us the insights from this report. So without much ado, I will turn over the floor to Asli.
Okay, thanks a lot for joining us today, and let's see when the presentation comes up. Today I'm going to talk to you about a new report that we have started in the World Bank. It's called Global Financial Development Report, and the whole idea of the report is to increase the profile of the World Bank in global financial sector development issues. And the first report that we've done actually focuses on the whole area of the financial sector policies after the crisis. And each report focuses on a theme, and the next one is going to focus on financial inclusion. But this is much more than a report, so I would like to draw your attention to the website, where there is plenty of data information, particularly on financial development. And if you're interested in benchmarking your country or in different dimensions of financial development. And just to give you a flavor, we've put together a very large database, which sort of is over 200 countries starting in 1960s, and this builds on work that we have done in the bank starting 10 years now. And basically we try to develop indicators of financial development, both for financial institutions and financial markets, over different characteristics that capture stability, efficiency, access, and depth. And I'm not going to go that much into it because we don't have time today, but I do urge you to go and look at this data and play with the data on your own on the website, just to give you a sense of the cool figures, etc. you could develop. This is how distorted the world map looks if you were to weigh the countries by the volume of their financial sector assets, for example. Okay, so let me get to the feature topic of this year's report. As you know, the crisis, the global financial crisis, really questioned the validity of our policy advice in the financial sector in many areas, and it has revived the notion that the government has a much more important role to play. And as a background to this study, we've conducted an informal poll of financial sector experts from around the world, and we've asked them questions about what they think about the role of the state in different areas of the financial sector that range from their role in regulation and supervision, competition policy, the importance of state-owned financial institutions, and even the role of the state in promoting financial infrastructure like information systems. And there, as you can see from this very short table, we've seen that there were quite different opinions, and the opinions varied across in terms of the role of the state. And our clients actually were looking to us to figure out what the crisis meant in terms of our financial sector policies. And one of the dangers of sort of moving ahead with reforms after a big crisis like this is that sometimes we draw the wrong lessons from the crisis. So in order to prevent that, we thought that 4 years after Lehman crisis, it was a good time to take stock of what we knew before the crisis, what the crisis taught us, and where we go from here. So I'm going to tell you very briefly what are some of the main messages of the report in these 4 areas. But again, the report itself contains a lot more information and background work, so you may want to refer to that later on. So one area that the crisis certainly questioned is, the effectiveness of the regulation and supervision as a result of this crisis. Now, clearly, this is not an area where the role of the state is disputed, but crisis also showed major shortcomings in market discipline and regulation and supervision. So the question here is not whether the state should be involved, but how to best ensure that the state role as regulator and supervisor supports sound financial development. And there are important trade-offs here. If you have too much regulation supervision, you would hamper growth and innovation, but if you have too little, obviously this may lead to crises. So there are calls for not more regulation, but the right type of regulation. And I think the most important contribution of the report in this area is based on a survey of regulation and supervision that we have conducted as an update of a survey that we've been doing for the last 10 years. And this survey covers 142 countries and over 730 questions, very detailed questions on the regulation and supervision around the world. And using the survey that was updated in 2011, we could address 2 questions. One is how did regulation, supervision, and market discipline differ among different countries, those that suffered the most from the crisis versus those that fared much better as a result of the crisis? And secondly, how did regulation and supervision and market discipline really change since the crisis? Okay, so this figure gives you some interesting tidbits and as to how regulation and supervision was relevant with respect to stability, because you can see that those countries that suffered the most from the crisis also had the least rigorous regulatory and supervisory environment. They had they had broader capital definitions. They had more sophisticated. They allowed for more sophisticated modeling of capital. So there were more room to conduct regulatory arbitrage. There was less strict provisioning, and also even when you look at the market information, there was less oversight of external auditors, lower standards for public data quality, and so on and so forth. So overall, basically, crisis hit countries really had weaker regulation and supervision practices and less scope for market incentives because there was much more also generous deposit insurance coverage, which also undermined the incentives of the individuals to exert market discipline and the lower quality of published financial information. Now, after the crisis, when we look at what's happened, we see that countries actually stepped up efforts on macroprudential policy, crisis resolution, consumer protection. But again, it was unclear whether the incentives for market discipline improved because as a result of the crisis, we saw the safety nets become even more generous, so that's a concern. And surveys suggest that there's scope for improving disclosures and monitoring incentives. So basically, this part of the report suggests that there is broad agreement that it's important to address basics first. And one of the important findings of the report is that when it comes to regulation, sometimes less can be more. Simpler but more strongly enforced regulation tends to work better because it's easier to enforce and it improves accountability. And also we see that across the world, the supervisory capacity in many of our client countries is quite weak and needs to be strengthened. So, if regulatory reform leads to a more and more complicated regulations that are even more difficult to enforce, this is very difficult in environments where the supervisory capacity is weak. And the other important challenge of regulations is, of course, introducing reforms that are incentive robust. So the market participants have less incentives to try to circumvent the reports and the regulations. So there the report suggests that in addition to auditing core principles, it might be a good idea to also conduct audits of incentives so that the regulators and supervisors are aware of potential incentive conflicts and the regulations are designed accordingly. So one of the advantages, I guess, after the crisis is that there is a lot more interest in regulation and supervision, a lot more communication across different groups, policymakers, regulators and supervisors, and the market participants. So while this is certainly an ongoing process going forward, we hope that the outcomes will improve as a result of that. So a second area where the crisis questioned policies is in competition. There were calls after the crisis for reduced competition because some individuals and some analysts thought that potentially too much competition was the culprit in the crisis. So if excessive competition is destabilizing, then what should be the role of the state? Should it be actually restraining competition? So we've done a lot of work in this area in preparing this report, both in terms of summarizing the existing evidence, but also conducting new research. And there we see that actually leading up to the crisis, the market power and instability, systemic instability, were increasing hand in hand. So it's not true that greater competition is necessarily leading to greater instability. To the contrary, if the state sort of improves market contestability and this is complemented with availability of credit information and contract enforcement, and if the governments avoid policies such as too big to fail policies that distort risk-taking, this does not necessarily lead to instability. Therefore, the right policies for the government is to ensure that there is market contestability through healthy entry and exit. Okay, so a third area where the crisis reignited debate is on the role of the state-owned banks. As you know, before the crisis, there's quite a bit of consensus that state-owned banks are not associated with desirable outcomes around the world. Therefore, they are generally linked to politicized credit allocation, in inefficiency in banking, leading to lower development and growth, and therefore there was these widespread privatization efforts. Now, one thing that came up as a result of the crisis is that obviously there were credit crunches, and the governments around the world found it convenient to use their state-owned banks in order to try to offset these credit crunches. And then this raised the question whether this potential counter-cyclical lending that could be done through state-owned banks in the aftermath of crises justifies their existence despite the potential problems related to their politically motivated lending and the past experience with state-owned institutions. And again, here we did quite a bit of research trying to understand the role that the state banks play in the business cycles, and we've seen that there's quite a bit of research in terms of trying to see what role state-owned financial institutions play in terms of promoting efficiency and promoting growth, but there wasn't as much in terms of what they do during downturns and upswings. And looking at that sort of led to some interesting findings. For example, we do find that indeed state-owned bank lending tends to be less procyclical, and this is also possible that it is actually counter-cyclical in environments where there is good institutions, and particularly in developed economies. And but it's also true that there are some regional differences. For example, we see that there was some evidence of countercyclicality in LAC during the last crisis in Latin American countries, whereas this wasn't the case in the European countries. And even in those countries where we did see some countercyclical lending, when we looked in greater depth into those cases, we saw that actually the loans were not necessarily directed to the most constrained borrowers, and lending growth by the state continued even after recovery, so questioning whether this was truly countercyclical. So this is an area clearly where there could be important trade-offs. But for sure, the crisis experience does not negate all the important empirical evidence that already exists regarding the potential negative effects, efficiency effects of having large state-owned financial institutions because of politicized lending. But there is still some potential also for using these institutions as counter-cyclical tools. Now there, obviously, the challenge is to address the potential governance problems of making sure that the these institutions are governed well. And the experience with a lot of these institutions suggests that the good practice examples are not all that plentiful. And indeed, as background for this report, we also relied on a large survey of development financial institutions. And we did see that it's difficult to identify a lot of best practice cases, although we do have information on what makes it best practice in order to address the inefficiencies in state-owned banks. And there it's important to have clear and sustainable mandates, it's important to have adequate risk management systems, sound corporate governance, but good governance practices are really challenging to implement in weak institutional environments, and that's why we don't see too many success cases in practice. And this sort of questions the wisdom of trying to use these institutions as short-term counter-cyclical tools and disregarding the longer-term costs of these institutions. So a final area where there has been a lot of discussion as a result of the crisis is the importance of credit information sharing, and again the role of the state in making sure there is adequate, good quality credit information. And before the crisis, again, the conventional wisdom in this area suggested that, well, there is provision of credit information both by the state and by the private sector around the world. And as long as, there is good quality information, it doesn't really matter who provides it. Now, some of the work that we've done as a result of the crisis and as background for this report actually suggested there could be an important role for the state, particularly in concentrated environments where private information sharing is less likely to emerge when banking systems are concentrated because of monopoly power. So certainly the state, again, there has a very important role in kickstarting the availability of information. And the state also has and can have a very important role in increasing participation beyond banks to non-banks, because having information across a broad range of institutions is also important in making sure that this credit information is complete. There is, as I said, a lot of detailed work in the report, but I just want to now conclude to give you some time to interact and ask me questions. But just to leave you with some main messages of the report, basically we do see that the state has a number of important roles to play that range from being promoter, owner, and guarantor, and regulator, supervisor, and overseer of financial system. And the right balance really depends on a number of factors, including the level of development and the government's capacity to engage in these activities, and this certainly leads to trade-offs. And when we look at the experience during the crisis, we see that there were quite a few direct interventions during the crisis, and there is certainly evidence that some of these work, partially at least in the short run, but also robust evidence that there could be potential longer-term harmful effects of these types of direct interventions. So as the crisis subsides, there's certainly a need for rebalancing towards less direct involvement. If I were to leave you with one thought as a result of the study, the overarching theme that we identify is the important role of incentives in finance. And really the challenge for the state's involvement is to better align private incentives with public interest. without taxing or subsidizing private risk taking. And this is going to be obviously more and more challenging in a globalized and liberalized financial system. So thank you very much for your patience. Now, we're going to have you a couple of questions for you to see. These are drawn from the informal poll that I mentioned in the beginning of the study. It would be interesting to see. Now, you obviously have the benefit of having heard some of the findings, but it would be interesting to see what your views are. So, okay, so I do see that 100% of you agree that you need more stringent, well, a large majority of you agree that you need more stringent financial sector regulation as a result of the crisis. So that's an interesting finding that we can talk about. Should we go to the next question? So what about the information environment? So what is your view on that? Okay, very good. These are all very consistent. So many of you, again, see a role for both, but clearly a role for the state as well. Okay, do we know how many people have responded when we see these?
Can't see.
Okay.
Mostly.
Oh, okay. So most people have responded. So
Right.
should we go?
Yeah, you may want to address that too.
Yeah, I just want to go over the questions, and then I was thinking we could just discuss them a little bit. So maybe we go to the next question then. So this has to do with the competition. All right. Okay, this is certainly my kind of a group. Can everybody see the?
Yeah.
Oh, okay, excellent. So there is more disagreement here. Maybe we'll talk about this a little bit more later, but certainly, okay. Good. So then we have one more question, do we? Okay. Okay, so we can see some differences of opinion in terms of whether the state-owned financial institutions played an effective counter-cyclical role during the crisis. So this is probably the one that is most controversial among this group, and probably it's also true that it's most controversial globally anyway. So it's a good indication of the differences in opinion. Yes, now. Yes. Now, we can open up to questions, and now you can type your questions in, and I will try to address some of your questions. But as you type your questions, I want to now react to some of the responses to the poll. I think of the four questions that we posed, the most sort of disagreement was for the, or at least the diversity of opinion was for the fourth question regarding the ownership of state, the ownership of financial institutions and the role they played during the financial crisis. Now, clearly, there is a diversity of opinion here, and certainly a diversity of experiences. It's potentially too early to have the final word on that, but the initial experience suggests that there were differences across regions, with Latin American countries showing greater effectiveness with respect to how their state-owned financial institutions behaved during the crisis. with respect to some of the other regions. But there are also a lot of questions whether this was true countercyclical lending when you look at who have received the credit as a result of this lending. Sometimes it went to the largest firms, not necessarily the small and medium enterprises that were most constrained during the crisis, and so on and so forth. I guess another important thing is to remove oneself from the short-term issues of the counter-cyclical lending, but whether this type of a function for state-owned financial institutions is important enough to potentially offset their long-term efficiency sort of impact, given all the evidence that we have in this area. So this is where the important trade-off is, and I think the answer hinges on whether it's possible to have good governance of state-owned financial institutions, and there we know that that's also very challenging, particularly in countries where the institutional environment is poor. Okay, so now can everybody see all the questions? Oh, okay. So let's see. Okay, so there's a question regarding the financial sector regulation, supervision, autonomy from the private interest. Okay, yeah. I mean, these are very important questions. Certainly, one important finding, and this is not only a research finding, this comes across from all our financial sector assessment programs and operational work that we do around the World Bank Group, is that in a lot of our client countries, the capacity in the regulation and supervision, supervisory capacity is weak. So if we want to have sort of effective regulation and supervision, we certainly want to invest in the supervisory capacity. That's true. However, it's also true that we want to make sure that the quality of the regulation and supervision is increased in terms of its autonomy and the design of regulations and regulations, particularly because clearly if you do not pay attention to the incentive environment, it doesn't really matter to what it doesn't really matter whatever regulation that you have, it's going to be always circumvented because market participants tend to have these incentives and they tend to be better at devising different types of loopholes and taking advantage of those. So one of the background work that we have done in this area sort of emphasizes incentive audits for that particular purpose. And as part of the incentive audits, you also can see to what extent there are incentive conflicts, obviously, and whether the regulators are captured by different private interest groups, and whether because of different types of guarantees, private sector participants do not have the right incentives to monitor, whether the information environment makes it possible for them to assess the good, the information and all those things are important to capture. Let's see. Well, I think one of the responses to the questions regarding regulation and supervision suggested you guys all support more regulation. I think I tend to disagree with that a little bit. I think the point of the report is not that you need to have more regulation. To the contrary, if you have more regulation as a result of regulatory reform, more and more complicated regulation, complex regulation, it's not obvious that that's going to lead to a better financial development and the positive outcomes that we look for, because as I said, for one thing, more and more complicated regulatory systems open up more and more loopholes for regulatory arbitrage, so market participants are always able to find ways to circumvent these regulations. But secondly, it becomes very difficult to enforce some of these very complicated regulations. As I said, since in many of our developing countries the supervisory capacity is weak, it's not clear again that this would be an improvement. So, for example, if you think about capital regulation and think about the risk-based capital regulations and how difficult it is sometimes to assess the risk weights and sort of enforce these types of regulations. Sometimes in the more rudimentary environments, it might be much better to have a simple leverage ratio that can be adjusted upwards with simple, more observable measures of risk, such as the spread banks charge their customers on their loans, for example. So it's not always more regulation, but it's probably better regulation that takes into account potential incentive problems and also is simple enough to enforce and monitor. So there's some complaints that the connection is not good. Okay. So I also have a couple of other questions here. Okay, so there are some questions regarding a very interesting potential research, follow-up research on these issues, and people are asking where they could contact different individuals. I guess on our website there's a place to post ideas and questions for next reports or even related questions to this report. This is on the first slide of my presentation, so please feel free to go to our GFDR website and send us questions and comments, and you could also contact us through that website. Okay. Okay, let's see. I can't see this very well. All right. Okay. So somebody's mostly. So I'm trying to see what it is. I'm just trying to see. I'm just reading some of the questions because it takes a while to read the questions and answer as well. Okay. There is a question that whether we think US and UK had weaker regulation and supervision compared to what. I think it's there. It was mostly with respect to the implementation and the weak incentives for a market discipline. So clearly, if, for example, if you have very generous safety nets and too big to fail policies, you provide very distorted incentives to the private sector, and then think about it as a system where the exit mechanism is completely broken. Then when you have a system like that, it becomes very, very difficult for any regulator, any supervisor to do a very good job, because you have very sophisticated market participants, and their incentives are such that they could sort of reap the benefits of upside risks, and they don't have to suffer the consequences of the downside of the risks they take. So I think it becomes incredibly difficult to have effective regulation and supervision. That's why we have seen a very significant amount of debate in the developed countries regarding too big to fail and how to sort of address some of the exit mechanisms. I think a lot of progress has been made there, but a lot more remains to be seen. Okay, I see that some people are typing, but the questions do not come out. Oh, here we go. Okay, so there's an interesting question regarding the differences between US and Canada, and we recently had a talk on this in the World Bank. One of the things that we often hear is, well, when you look at the history of US and Canadian financial system, you find the Canadian financial system to be much more stable than the US financial system. And when you compare Canada and US in terms of their structure, you see Canada to be much more concentrated, and therefore people think that, well, this is evidence of less competition leading to greater stability. Now, one thing that people don't know, and I didn't know this for till recently either, is that Canadian regulators actually have an important threat that they hold. There is every so often, I think it's 10 years or so, they have the right to evaluate and cancel the charter of different financial institutions if they find that they have been abusing their privileges. So to a large extent, this introduces a significant threat of entry to the financial sector by potential competitors at the expense of the incumbents. So I'm sure this leads to a significant, discipline and mechanism that we don't see elsewhere, and this is not well publicized. So now this is one answer. Of course, there is also the other side of the coin. I mean, to the extent if you have less competition, you're also going to have less innovation and less growth and less financial sector innovation too. So there's also the criticism that in Canada there has been much less innovation, and therefore the Canadian financial system did not contribute as much to the overall economic development either. Let's see. Okay, so there's some more questions coming in. Okay, there seems to be ongoing connection problems. I'm not quite sure why everybody is having difficulty connecting. Or is it too? Okay, lots of people are writing about it. Innovation is now. Oh, inclusion is certainly a topic that's very close to my heart. And I can't agree more that we do need to invest in better inclusion. But when we say that, we also need to be careful about sustainable inclusion, right? One of the issues regarding the latest crisis is potentially we had too much inclusion in terms of the access to mortgages. And this was not sustainable, clearly, and it sort of it led to, or at least precipitated, the crisis. So inclusion should not be just for the sake of inclusion. Inclusion should be done responsibly, particularly when we talk about inclusion with respect to credit services. But we need to think about financial inclusion much more broadly, obviously, and we do have an ongoing research agenda in this area where we look at different financial services that range from, deposit, credit, as well as payments and insurance services. And we have been exploring to what extent across the world different individuals use these services, and what are the impediments to use of these services. So this is certainly an area that we are doing much more. And as I said, the next version of the Global Financial Development Report is going to focus on financial inclusion. And okay, so we're getting some more questions, but one question that I would like to pose here is whether you see or you can think of different topics for our next few versions of this report. So as I said, the next one is going to be on financial inclusion, but if you have suggestions on different topics, we'd be very happy to hear now or later as you think about them, and you could always post those on our website again. And you can find the site on the first page of my slide presentation. Now, there are more questions about the research on financial inclusion. Maybe you should just send me an email, because I could send you the relevant sites and information on the financial inclusion as well. Okay. Yeah, the political, there are two questions in terms of the scope of regulation and also the political issues regarding regulation. I agree with these points, actually. There's certainly a very important feature, component of political economy when it comes to regulation and the incentives of the regulators in enforcing the regulation. And this type of regulatory governance is very closely linked to the political economy considerations. I guess we could provide email addresses. People are asking for email addresses.
Let me respond to that one. Some are asking, some don't want to share. So.
Okay, so that information will be forthcoming. Okay. The point about regulation being linked to growth and ensuring that it's not overly tight so it does not constrain growth is certainly something that we agree. This is one of the important trade-offs that I mentioned when I started talking about this topic is that obviously if you have too much regulation, you could hamper innovation and growth, whereas if you don't have the right type of regulation or too little of it, you end up with crises and instability. But I also want to emphasize that regulation should be incentive compatible. You cannot fight the markets. You need to enhance the power of the markets to self-regulate, or at least make sure that the markets have the right incentives to both monitor individuals, across the different participants. And there are two important features of that. One is to make sure that there is transparency and good quality information, so that people who want to monitor have access to the information that they need in order to monitor. And the second aspect is the incentive to monitor. Obviously, unless market participants have their funds at risk, they would not have the incentives to monitor. And this is where the safety net policies and constraining these very generous subsidies become very important. All right. So, there's a question about innovation in financial markets and how productive that innovation is. Certainly, that's a very important question, and that's a research question that there's quite a bit of research ongoing on that topic. So, what were the best cases? What were the lessons to be learned? Well, I think what I tried to present to you in this presentation is a synopsis of the lessons that we learned from the research that was conducted before the crisis. Just a summary of all the conventional wisdom and the literature, but also some new research as a result of the crisis to draw out the lessons of the crisis. So in those four areas, basically what I try to present to you is where we are now. Now, as you know, research is never conclusive. This is where we are at this point in time. This research is going to continue. There's always going to be more data and more evidence and more papers that we will be working on going forward. And in a couple more years, we will revisit some of these things that these policies that we have today, and we'll revise as we find new evidence. The whole idea is to make sure that our policies are evidence-based, and that by definition suggests that we will have to conduct continuously more research and learn more and revise our policies on an ongoing basis. Yes. So I think this has been very useful for me, and I really appreciate you joining us this morning on this webinar, and thank you again for your interest and attention.
Thank you, Asli. We had a very interesting presentation today by Asli Demirkog-Kunt, Director of the Research Group of the World Bank and Chief Economist of the Finance and Private Sector Development Network of the World Bank. I also wanted to thank all the participants. We had a very good turnout today, and all of the participants have been actively interacting with the speakers and with each other. We will definitely have a recording of the presentation, a video recording of the presentation available on the website you see on the screen, on the E-Institute website, as well as the PowerPoint and the URL to the resource and website that Ashley was pointing out. Before signing off, I want to remind you that we have another interesting webinar on January the 16th, again from 10 to 11 Eastern Standard Time, and this is in the Climate Change series. The title is Post-COP Doha, Reflection on the Doha Gateway and the Way Forward. Again, this is on January 16th, and the speakers are Mr. Neeraj Prasad, Manager of the Climate Change Practice in the World Bank Group, and Mr. Zuman Wang, Senior Carbon Finance Specialist. So hope to see you on the 16th.